Welcome to my YouTube channel, The Unfolding the Stock Market Crash. Hi, I'm Phil Grande. This is December 2nd. Okay, let's start out. I'm going to tell you right now that we're adding again, okay, to our list of things that are taking this market down. And today it's going to be about tapering. Now, to understand tapering, let's start out with going back to 2008. When you go back to 2008, it was really simple. The big plan was print a whole bunch of money. You can see here right on my chart that I designed here for you today. The idea was to print a whole bunch of money right here, see it? They were printing $120 billion a month. They took that money after they printed it and they went in and they purchased treasuries. When you purchase treasuries, yields then turn around and drop or raise. Now, why did they do that? Because what benefits from low yields? Your biggest tech stocks, meaning not in size, but in performance. The tech stocks that they want everybody to buy are the six most popular, which is, of course, your Facebook, your Google, your Amazon, Netflix, Microsoft, and Apple. So they want everybody to buy those 6 stocks. Why? Well, look at the chart. Because those 6 stocks right here contribute, okay, 27% to the S&P market or rally. In other words, 73% of the S&P 500 stocks are pushed up by these 6 stocks right here. See how that works? So going back to 2008, instead of rebuilding the economy, which they should have done, they said, let's prop the market up with this new technology. Everybody's after tech stocks. Okay, this is going to be a boom. And that's exactly what they did. So everything was print money, drop those interest rates down, and then low rates move up big tech stocks. And the most popular ones, the 6 that I just gave you. That's simple. That was a con job right there. They screwed everybody. This way they took care of the 1 percentile, and they took care of the 1/100th of 1% of the population. And they screwed Main Street. They knew they were screwing 72% of our workforce. That's right. 72%. But they don't care. What do they care? Now, they're saying it's time to taper. Why is it time to taper? Well, during the 13 years, every time that they wanted to taper and cut back that $120 billion a month to $20 billion a month or $30 billion a month, panic hit. So in other words, if you take, and I'll show you right here, let me just get rid of this. And let me just move my little guy over here for you like this. Here we go. Now remember what happens, okay? When you have low yields based on printing all of this money, and all of a sudden you say, hey, it's time to quit. We got to stop with this QE because it's causing too much inflation. Because what's happening is we got gasoline going up, we got everything going up, and the working folks, 72% of our workforce who make a combination about $65,000 a year, they're getting screwed. Their confidence is eroding. They're stopped consuming. In fact, this November, just a couple of weeks ago, remember what happened? They found out that the consumer, his confidence is almost at an all-time low because of this inflation. You go buy gasoline or you know what I'm talking about. So now, if you look here on the chart and you see where Powell says, "Hey, it's time. We got to go ahead now, and we got to stop this because we got to stop this QE. Got to stop printing money and dropping it. We got to raise rates." Guess what the problem is? Well, remember, if you're going to start reducing this pile of money here, the printing of that 120 billion, you're going to start that pile is going to start going down. The investor panics because for 13 years the investor has been addicted to these 6 stocks. Everybody wants to buy Apple. Everybody wants to buy Microsoft. They're addicted, and they've been making a fortune, because the only way to get that stock not to go up is not to print money. So as long as you print money and drive interest rates down, called the yield, these stocks go up, and these guys made a fortune. Now they're panicking, and they're saying, what am I going to do? So everybody's starting to shift out of the stock market right now and going into the bond market. And there is the problem. When you shift out of the bond market and you shift out of the stock market to the bond market, the problem is when everybody's buying bonds, guess what goes down? Yields. And low yields have been linked to what? These stocks right here. So the other day, everybody started to buy, when they saw the yields go down, people who aren't professionals started to buy the tech stocks. Oh, God, yields are going down. I'm going to start buying these tech stocks. I made a lot of money. But they didn't understand something. The tech stocks weren't breaking out. Tech stocks were not breaking out. Okay, so when they weren't breaking, why weren't they breaking out? Because institutions weren't buying them. Then all of a sudden the market tanked. Remember? Market went down and tanked. So the last thing that's going to take this market down, it's going to really hurt with this tapering, is this guy right here. Because, again, remember, the biggest problem with tapering, if you go all the way back to the dot-com days, okay, during the dot-com days, we had about $350 billion in borrowed money. Notice, people wouldn't borrow $350 billion to go buy stocks. Then when the housing bubble started, traders went and borrowed $550 billion to leverage themselves to buy stocks. We're at almost $1 trillion. So here's the problem. When they borrow money, okay, interest rates are going to go up now. So that means they're all going to get a bill. So that means their margin interest rate is going to go up. And what happens when they do that? They don't write a check. What do they tell the broker? They say, sell my stock. And that's what happens. All of a sudden, everyone says, sell my stock, sell my stock. And guess what happens when they start selling the stock? It's like someone yelling fire in a theater. And everybody starts selling, and that's how you start getting a crash. So think about this. We are so close right now, but I don't think he's going to taper because, as I just explained, the economy that we know is too fragile. He cannot. I mean, how's he going to taper? Because this whole market is so fragile because it's been built on BS, built on QE. So if he does taper and raise rates on a market that's built on quicksand, QE, this is going to be the biggest crash ever. So between now and December 14th, 15th, we better be very careful, okay? Very careful, all right? Because that's when he's going to make his announcement. So there's going to be a lot of volatility in the market. So just follow my chart, my color-coded chart. And you always be on the right side of the transaction, especially if you know how to short. If you don't, join my gang, Phil's gang, free for 10 days. So that's it. So we'll see what happens between the 14th, 15th of December. Is he going to taper? I don't think he is. I don't see how he can. But if he's that stupid and he has to, then we're going to make a lot of money with a market that's going to collapse. See you on the charts.